Daniel here, Gen Wealth Concepts. I wanted to talk about whole life insurance versus term insurance. What are the differences? Okay, well, the difference is, let's just start with term. Term is what some people would call, if you're looking at, some of the people out there, the gurus, whatever they consider themselves to be, they call it pure insurance. But it is the equivalent of your auto insurance in a way, because if you stop paying on it, it goes away. You can say, well, that happens in whole life. Well, no, I explained in the last video, I explained how you had options to where you could keep that permanently. Hence, whole life, meaning for your entire life, for your whole life, and it being a permanent insurance, where term is not. Term is exactly that. It's for the term of time between, whether it's 10 years, 20 years, 30 years. And the problem with that is what happens is a lot of people buy this inexpensive insurance either out of financial reasons or because they're like, well, I'm going to take the extra money and I'm going to do something with it. I'm going to make more money. So I'm just going to buy the cheaper alternative. They never end up doing that. Now they're 20 years, let's just say 20 years, because it's the most common one. And the statistic is that a very, very low, single digit percentage of any term insurance ever pays out. That is why, most insurance companies offer it, is because it doesn't pay out. It doesn't have to. So that's money in their pocket of the insurance company, one. But two, what happens is that thing runs out, the term runs out. So you get it at 40, it ends at age 60, or let's just say 45 and 65. You get to 65, you're not in so great a health in a lot of cases. You go to try to get insurance and it's super expensive. And most people can't afford that. They can't afford some super expensive insurance policy that gets more expensive as you get older. And even then, they're probably only going to do it for a shorter period of time for you to ensure that premium stays level, one. Two, if the premium, you get there, the premium's so high, you can't afford it, what do you get? You get what's called final expense insurance. This covers maybe up to $50,000. And even then, for some people, that's still expensive. Say you get it for $30 or $40 a month, and it's a whole life policy. It is. It's not a great whole life policy in the way that it doesn't really build up a whole lot of cash value at all, but it is a permanent policy. So if you did a 10 pay, which 10 annual payments, or maybe payments for 10 years, monthly payments for 10 years, it would be permanent at that point. But it is much smaller. And it's called final expense for a reason, because it's used to tie up some loose ends and pay for your funeral when you pass. So is that what you want for your family? Is that really what mind you, that's not even the point of this video, but so comparing that to whole life. So in actually term, before I leave term gets no cash value. There is an option, what's called return of premium, but they're holding your money for 20 years and then they're giving you back the same amount of money. You get no growth on the money. There's no upside to it. Some people see that as a win. I don't see that as a win, because if somebody's holding on to my money, I expect them to pay me some sort of interest. So that's term. Whole life, on the other hand, builds cash value, is permanent, and has many options. Both have the availability, depending on the insurance company. Again, all this is going to depend on the insurance company. In a lot of cases, depending on the basic stuff I'm talking about, is going to hold true. But both types of policies can have living benefits, where basically you can dip into the death benefit and use it if you're in critical or chronic illness type of situation, terminal illness type situation. It's so that can hold true in either case. But with whole life, you're gaining that cash value after, say year 3 or 4, let's just say 4 or 5. Let's be fair, 4 or 5. You're getting paid back, or you have more available in cash value to you than you paid in. And that will just keep going up each and every year more than the previous year. So you will never end up with less money than the previous year on what you pay in and what they're allowing, or I won't say allowing, that's the wrong thing. You are technically a shareholder in the insurance company with participating whole life. You have that continually going up. You have options. I talked about the payment options in the other videos. You can go reduce paid up, but it's still permanent. You may not pay any more into it. You can't pay any more into it. It buys a set amount of death benefit. You can't pay into it anymore. But it's done. It'll continue to grow. I will put that out there. It'll continue to grow. You'll continue to get dividends on that money. You can go premium offset. That means that you reach a certain point, you're like, hey, I don't want to pay into this anymore. I'm tired of payments. It'll take a loan. It'll pay the base premium each and every year, and it'll continue to grow. In spite of the loans, in spite of the interest rate on the loans, it's going to receive growth over the years. Okay, permanent. Again, the likelihood of it lapsing for any reason is very, very, very low. When I say low, something horrible would have to happen. And in the last 150, 200 years for most of these insurance companies, that has not happened. So I'm giving very, very extreme worst case scenarios on that. The flip side is you just pay the base premium and it keeps going. It's still going to increase in cash value. You pay that out of pocket. It's not going to have as much growth until in the later years, but it's still going to grow. So for me, if after say 4 or 5 years, you're paying me back, or you're paying me additional money on top of my money that I'm putting in, why wouldn't I do that as opposed to paying 20 years? But you're like, it's more expensive. Doesn't matter. You get your money back. You have your money. You have your money, and then you're going to break even, and you're going to far surpass anything else. Well, what if I could have invested in the market? Well, look at the market right now, and I'm not even going to get into that. But my father lost hundreds of thousands of dollars, and he's 80. Why he's still in the market, I don't know. I've been talking to him about that for years. But let's just go on. You can take a policy loan and you can put it wherever you want. You can buy real estate. You can buy crypto. You can put it in the market. You can do all of these things. You can day trade with it, whatever you want. And the money's gaining that uninterrupted compound interest in this whole life policy. So for me, that's where my money's going. My money's going to go in this policy as opposed to into that term policy. Is there a place for term? Absolutely. Do you start out, you're using a cash value policy, it's got a lower death benefit, you want a higher death benefit so you can cover, say, 5 or 10 years worth of lost income to your family if something happens to you, especially if you're the primary wage earner. Of course, it has a place. But when this policy hits that, there's no reason for this policy over here, in my opinion. Could it be just extra money for your family? Absolutely. If it's cheap enough, keep it. But why? And on top of that, you can have multiple whole life policies. I've got 10, maybe 12. Anyway, I have several. I put tens of thousands of dollars into my whole life every single year. I probably put somewhere around 50, 60,000 right now. I'm not anywhere near the top of the food chain with that. I know other individuals who are putting hundreds of thousands of dollars, but they see the value in it. It's safe. it's liquid, and it's got the tax-free benefits of accessing the cash. To me, that's the clear winner. Catch you on the next one. My links are below. Please like, subscribe, hit the notification bell, and we'll see you later.